Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Sphere Entertainment Company, ticker SPHR. This company, born out of this single multi-billion-dollar Las Vegas spectacle, is attempting one of the most audacious financial transitions we've seen. They're trying to move from being a capital-heavy venue operator to a global technology licensing giant.
And that really brings us to our thesis for SPHR. SPHR is transforming into a global IP and technology licensing powerhouse, proven by the $720K per show revenue of The Wizard of Oz at Sphere and the capital-free Abu Dhabi franchise template, which validates the extreme financial upside against the persistent challenge of content execution risk and the necessary $205 million Sphere net debt.
Wow. That thesis, it frames the entire conflict perfectly. It really does sound like a pure high-risk, high-reward bet on technological disruption. So our mission today is to unpack that blueprint. We're going to look at whether the financial structure can truly support that global ambition, or if the risk of, content failure is just too great. Let's start with the financials. The market was holding its breath for these Q3 2025 results. This was the moment of truth, right? Did the operational ramp-up in Vegas finally prove that this could print money, or was it just a massively expensive white elephant?
Well, the initial data confirms the former. The ramp-up absolutely paid off, and it confirmed a real inflection point. For the September quarter, the total company revenue clocked in at a strong $262.5 million.
That's the high-level number. But we know investors are laser-focused on the Sphere segment itself. And that's where the growth has to come from.
Exactly. And if you look at the core business, the Sphere segment brought in $174.1 million in revenue. That's a phenomenal 37% increase year over year. And this rapid growth, it's driven entirely by that increased activity and the new film. That's what led to the critical shift in profitability.
Okay. That shift being the adjusted operating income, the AOI.
Yeah.
Why is that specific metric the one we need to focus on and not, say, simple net income?
That's a really crucial distinction. We focus on AOI because it strips out all the massive, non-recurring, one-time charges that came with building the thing, the multi-billion-dollar construction. AOI shows us the true core operational performance of the asset now that it's actually built and running.
And what did that clean metric show?
It showed the inflection. The Sphere segment AOI hit $17.1 million for Q3 2025. And what's fascinating here is that this is a major reversal from the $26.3 million operating loss they reported in the exact same quarter just 1 year prior.
Whoa, wait. From a $26 million loss to a $17 million profit.
In 12 months, it proves that the asset, when it's fully operational, it works. The model is profitable.
Okay, that is compelling operational data. But let's step back a second and address the skepticism. You constantly hear investors flag SPHR as heavily indebted. I mean, the construction cost was astronomical. Does positive AOI really matter when there's this perceived mountain of liability hanging over them?
That narrative needs some clarification, definitely, especially after management restructured some of the debts. While the total liabilities are high, analysts calculate the adjusted Sphere net debt is far more manageable. It's sitting at around $205 million.
Okay, walk us through that $205 million calculation, because the raw numbers sound big. You've got, $329 million in cash, $259 million in convertible debt, and a $275 million credit facility.
It requires an adjustment. So first, the cash position is strong. Second, that $259 million in convertible debt is key. This isn't just a straight bank loan. It's a liability that can, at the lender's option, be converted into shares of the company. It's often viewed more favorably because it might become capital instead of a fixed cash repayment. The cleaner net debt figure shows the Sphere segment isn't drowning anymore.
So the financials are de-risking while operations are proving profitable. Now let's pivot to the engine driving those numbers. The content. The Wizard of Oz was supposed to be this scalable, high-margin proof of concept. How did it actually do commercially?
It was, quite frankly, a triumph of execution. It proved the demand is there, and it is huge. WOZ is averaging an incredible $720K average revenue per show at 90% occupancy.
Hold on, $720,000 per show.
Per show. And that metric isn't just good, it is more than double its predecessor, the first film, Postcard from Earth.
Double the average revenue per show is just stunning. And it seems like this isn't a fluke either. The production hit over $130 million in tickets sold by mid-October 2025. That's over 1 million tickets. This is real money. But why is this model so much more profitable than, say, a concert residency.
It's the magic of digitization and fixed cost leverage. So the reported initial investment for WOZ was around $100 million, but once that figure is paid off, increased occupancy for these films leads to a nearly 100% contribution profit model.
So once the content is built, running the digital file over and over has almost zero variable cost.
Precisely. The lights, the AC, they cost the same whether there are 100 people or 10,000 people watching. That leverage is what drives sky-high profits. It turns the venue into a giant digital printing press.
And here's where the tech execution gets really interesting. I heard the story that the content was almost a total failure. The original film's aspect ratio just didn't work on that massive curved screen. It threatened the whole project.
They were facing a crisis, absolutely. They needed a technical Hail Mary. And the solution was cutting-edge AI specifically, AI outpainting. This technology was critical to intelligently expanding the original frames of the film, generating new background details that didn't exist before, so the content could fill that colossal display naturally. It literally rescued the production.
So the tech saved the film. But you mentioned the 4D effects. Is the secret sauce in the tech that built the venue or the tech that fills it? Management learned the spectacle wasn't enough, right?
They learned that the full sensory experience is the IP. The 4D effects are absolutely key to the customer experience. And we're not just talking about vibration, we're talking about 10,000 haptics-enabled seats that let the audience literally feel the action. And that's paired with massive 750 horsepower fans creating controlled wind and fog to simulate, well, a tornado passing through the room.
Wait, did you say 750 horsepower fans? That's like a sports car engine just to blow wind on the audience. It just shows how over the top, how immersive this physical technology is.
That is the point. It's the integration of hardware, software, and content that forms the defensible IP. Which brings us to the critical strategic question. How does SPHR scale this globally without sinking another few $1 billion into construction?
That is the ultimate challenge. They can't just keep building $2 billion venues.
So they shift. They shift from being a capital-heavy operator to a capital-light IP licensor. The capital-light franchise model is the blueprint, and the Abu Dhabi agreement is the template. The key takeaway for you as an investor is that you are now buying an IP company, not a construction company.
And what are the terms of that Abu Dhabi deal? Who takes on that massive financial risk?
The partner. In this case, it's the Department of Culture and Tourism. They will fully fund the construction. SPHR doesn't spend a dime on steel or concrete. In return, SPHR gets an initiation fee, service fees, and most importantly, ongoing royalties and fees over a massive 25-year franchise agreement. They're selling the blueprint for decades of revenue.
That completely shifts the risk profile while maximizing their content. And it's not just full-scale spheres they're looking to franchise, is that right?
No, strategic diversification is key here. SPHR has completed designs for smaller, faster-to-build venues, the mini-spheres. They have seating scaled down to 3,000, 6,000, and 18,000 seats. This makes the tech viable for secondary markets all over the world.
And the financial upside of those smaller venues is still pretty significant, I'd imagine.
Oh, absolutely. Analysts estimate each small sphere could potentially add around $20 million in AOI per year. So if they sign just a handful of these capital-free franchises, it radically changes the company's entire earnings potential without adding all that debt and construction risk.
And we can't forget the technology licensing aspect, which is totally separate from the venues themselves.
That's right. SPHR owns a formidable IP portfolio with over 60 U.S. patents. They cover everything from the venue geometry to the audio tech. And they're already showing success with licensing things like Sphere Immersive Sound, which has been installed at places like Radio City Music Hall. It's a whole third monetization path.
Okay, so let's pivot to the risks. The big, persistent, existential risks. The core vulnerability here has to be content consistency and execution. The whole model just collapses if the films aren't smash hits.
That is the single largest threat. Content execution risk. Even with the WOZ success, critics initially had some pretty harsh words about the tech they used. We noted the initial media criticism of the AI usage, with some critics calling the results absolutely terrible and saying the original film was radically mutilated.
That's a huge contrast. So the critics hated the method, but the audience loved the result, giving it a 4.7 out of 5.0 rating.
And it creates this fascinating structural tension. The high audience rating proves the demand is there, but the initial critical reaction highlights that they're relying on a sustained pipeline of $100 million plus projects. It only takes one failure for that revenue to stall.
And when you talk about going global, you introduce all sorts of new risks.
Right.
beyond just the content.
Certainly. The capital light model is brilliant, but it relies on geopolitical stability and, strong IP enforcement in these new markets. Signing a 25-year deal in a foreign country involves partnership risk, political risk. A lot of things can go wrong.
Okay, shifting back to the financials for a minute. That financial firewall they created, the parent company had to insulate the high-growth Sphere segment from its legacy media business. Can you tell us about that strategic de-risking move?
That insulation was vital. The market was basically discounting the Sphere's growth because of those older assets. So they executed the MSG Networks restructuring. Crucially, the MSG Networks debt was made non-recourse, with the term loan cut to $210.
Wait, what does non-recourse mean in practical terms for the Sphere business?
It means a financial firewall was put up. So if the MSG Networks business defaults or has major financial problems, its creditors cannot legally go after the assets or the cash flow of the Sphere business. Not in Las Vegas, not the future licensing revenues, nothing.
And that firewall was necessary because that legacy media segment is facing, well, some serious headwinds.
Absolutely. That legacy segment still deals with the industry-wide problem of shrinking cable viewership. Specifically, subscriber declines, which were down about 13.5% year over year. The separation lets the market value the Sphere on its own disruptive merits.
So let's synthesize this. We have proven operational performance, a super profitable content engine confirmed by WOZ's $720 per show revenue, and a scalable asset-light global business model confirmed by Abu Dhabi. Does the current valuation account for this massive upside, or is there a structural gap somewhere?
The bull case is strong, and it's rooted in that high demand. Analyst data is showing $3 million in daily bookings for WOZ, which is far exceeding consensus. And the confirmed capital-light franchise model validates that global upside. However, there is a structural gap tied to analyst expectations that needs to close.
So you're saying the market consensus needs a pretty significant upward revision.
Exactly. Analyst models are just lagging behind the success of WOZ and this new structure. The current consensus AOI is only around $140 million. But for the stock to really justify the bull case valuation, those high stock prices, that consensus has to rise significantly, up toward the analyst forecast of about $200 million AOI. Until that happens, SPHR is still fundamentally a high-risk bet on global disruption underpinned by the success of WOZ. What's really fascinating here is that the whole structural shift from a capital-heavy operator to a capital-light IP powerhouse, it depends entirely on continued content magic and actually signing those global franchise deals. It's a pure execution story now.
I think this raises an important question for you to consider. CEO James Dolan's personal compensation targets are tied directly to the stock hitting between $75 and $150 per share. Will this extremely strong personal incentive finally be enough to eliminate that historic Dolan discount that has plagued the stock and force the market to finally re-rate SPHR as a technology giant, not just a stadium builder?
Risk defined. Portfolio protected,